Welcome to another riveting edition of Risk and Return. I'm Charlie Gasparino with my partner, the daddy of data. Good, I'd save that for the show, Bob. But that may be your moniker going forward. The daddy of data, Bob Sloan, the founder, the chairman, the grand poobah of S3 Data Partners, the ultimate source for trading data, particularly on long and short trading data, which we try to unpack here for you, for people that are in the markets and we don't tell people what to do. We just give the information and tell them what the information is saying, and that's the sort of vig that we bring to the market. Bob, you've been animated lately on the notion of battleground stocks versus meme stocks. Now, what's interesting about this, for people who trade and follow trading news, is that these names get thrown around constantly, and no one sort of unpacks them and defines them. Why don't you give me your definition of what is a battleground stock, what is a meme stock, and how important are they to the sort of trading zeitgeist in the markets? And these are, this is like a big thing, my view, if you're in the markets every day.
Well, first of all, we'll give like a free dinner to anybody that comes up with the best daddy of data meme. So, we'll do that.
Well, at least I didn't call you the granddaddy of data because you don't have grandkids yet.
Exactly. So, but the daddy of data, I love that, Charlie. Thank you very much.
Okay.
So yes, we have been very animated lately. Why? We are very anti-jargon. You and I have been doing this show now a couple of months now.
Right.
2 months. And we try to say what things are and define them simply so that the viewer really can penetrate the language. When I first started Wall Street, which was, a long time ago, but one of the best lessons ever was my first day on the job. And someone said to me, very senior guy, just said, Bob, it's just the lingo. It's just lingo. And if you can solve the lingo, you can actually start to explain things simply, and then you can start to understand. And he was dead right. And so this past week, we've seen such an amount of jargon and lingo being tossed around because these things get clicks. So for example, you and I have been talking about battleground stocks and why they're important. And lo and behold, many of those stocks that we put on a table last week, I don't know if we can pull up last week's table, but during the show, we can go back to that. One of those stocks was Kohl's. And
yes.
we said, look at the amount of active long versus short interest. It's almost equal.
Now that's your standard definition of a battleground stock in the market, where the market really hasn't made up its mind whether this is a dog or or something that's going to make them a lot of money. Right?
That's right. So you have equal conviction on both sides, fighting each other every single day. And what's important about that is because you can look at the float and you can look at the outstanding shares. People confuse those things all the time. Outstanding shares, how much has been issued. Float, how much can be traded. But then you have to define how much can be traded. Well, an index fund doesn't trade every day. So you take that out of the float. You take treasury stock out of the float, take insiders out of the float. Then you start to say, okay, what constitutes that float? Active money managers or buy and hold is a different strategy versus short retail. Well, in today's world, I also think that's another misnomer. In today's world, index is retail.
Yes, you're
really,
right.
It really is. It's become retail. So passive indexing has taken over from what was 25 years ago. People would invest with an active manager at XYZ big mutual fund. Now they own a BlackRock ETF, where they own some kind of State Street index fund, etc. So you take that out of the flow, then you see where the battle really is. Now, lo and behold, we have gotten calls from so much media over the last 3 or 4 days.
Huh.
So much media. Now, not educated, smart, I would say the king of all news, which would be you. If I'm the daddy of data, you are the king of all news.
Yeah,
Okay.
thank you. I'm competing
You are.
with
You
someone else
are.
on that one, but
But
anyway,
we
go
let's
ahead.
go. Yeah, well, but that's true. But he's media. You're news. That's different.
That's true, true, true.
Big difference.
So they're calling you on these battleground stocks and conflating them with meme stocks.
That's exactly right. And so the
Now,
same.
how would you define a meme stock?
Well, where the meme is the cause of the speculation. So, for example, when Roaring Kitty puts out an Uno card, who knows what that means? People buy it.
So
That
it's the source that makes it the meme.
I think so.
If it's Roaring Kitty or if it's a bunch of apes, as they call them on AMC,
That's right.
there's also the meme is also there's a social justice element to some of this stuff. We can screw the hedge funds and
100%.
stick it to the bad guys who are
Stick it to the
distorting the
bad guys, stick it
markets.
to the short sellers, stick it to this guy. So we got all these calls this week about Coles. Coles was up 30% one day, then it was down 15%. It's up, I think it's like 17% today. It has that much volatility because the conviction is meeting, the immovable force is meeting the irresistible object, and it's moving
And
back.
people are calling that a meme stock.
They're calling it a meme stock. It's
That's
not.
crazy. It's not.
It's a battleground stock.
Right.
Big difference. And so when stocks go up that are getting talked about, people say, "Oh, that's a meme stock." It's not. A meme stock, a true meme stock, is when you have short interest way bigger than the long, and it gets squeezed, or you have the amount of money being lost by the short interest component of a particular stocks.
And the source is really is kind of funky too. You have to
Yeah,
throw
it's fun. Right. But it moves prices, right?
it's
So
following a
that's
meme that
following a meme.
we're sticking it to the bad guys.
That's right. That was sticking to the bad guy dog kind of thing. So, Coles, we've been talking about that. We've been talking about C3 AI. We talked about Rivian. A lot of these stocks all of a sudden become very volatile, precisely because I think we've been putting a focus on where is the capital really being deployed. So we did a study this week. We took a look, and it turns out about 4% of all the shorts in the US are in these battleground stocks. So it's not a small amount of money. It's actually about $50 billion. The active longs, mostly hedge funds, right? On the other side is about $50 billion. So you have active hedge fund, $50 billion. Short seller, also definitionally hedge fund, $50 billion, fighting each other in these stocks. That is not a meme stock.
No.
That is a technical weight of money, flow of money, capital flow situation.
Now, what
And
happens
that's why I think
if you how do you as a trader if you conflate those? Like, does that how bad does that cost? That could cost you, right?
well, if you're on the wrong side of Coles, it costs you 30% in a day. If you had
Right.
a 2% position, hey, that's 60 basis points of
If
return
you
you
thought the
lost, right?
meme if you thought the meme sort of momentum was gonna carry you, right?
That's right. If Coles was it depends on what percentage of the portfolio it is, and then if it's a 5% position, it's down 30%. It's a point and a half, right? So
Interesting.
that's a lot, right? To lose on one stock in a month. That's unacceptable risk management. So that is you can really damage your win-loss ratio, otherwise known as a Sharp, and you can look at your drawdown, how much you've lost over a period of time. Those things get really dramatically affected.
And any other stocks that fall into these categories that are getting conflated?
Well, we've done a lot of research. We love the Kohl's story because it's a famous name, it's a brand name, and there's a lot of
Oh yeah.
there's a lot of interesting characters, and it makes for a great financial soap opera. Now the board's involved, someone wants to buy the company. There's been all these accusations going back and forth in the company. So Kohl's is a great example of that. We'll post these things coming in the week of battleground stocks. If you actually subscribe, you'll get to see those things. and then we'll actually tell you what. And there's a long list. There's about 50 or 60 stocks, and we'll post like
which is the beauty of subscribing to S3 Data Partners.
that's
Right.
right, and watching this show is you'll get a
Right.
review. And so Coles is a great example, and it's made headlines. And I want to go back to the press a little bit, because the folks actually Investopedia get it right. A couple of them,
Investopedia.
they actually got it right. A couple of the mainstream media got it right. A lot of the financial news did not. And so there was a story in the journal about these are new meme stocks. Look at Krispy Kreme, et cetera. And most of them are not. They're not. They're driven by actual market dynamics that you can see and actually measure to see what kind of price action is going to be.
And
Because
much more fundamental bets, correct?
that's correct.
Rather than a momentum bet, which a meme stock essentially is. So just buy this thing, even though could be a piece of shit. We're just going to buy it and drive it up.
That's right. And so what we can show you is where the news is going to have the maximum effect. If the company does well, the next dollar on the long side is going to make the shorts cover. This thing's going to go up 15, 20%. The next negative news, longs will sell and shorts will pile in, and then the stock will be on 20%. So these are very high vol situations.
So you've been following this for a long time. Is this, I mean, are we an inflection point here between meme and battleground stocks? I mean, are we going to be now talking battleground stocks instead of meme stocks going forward?
Well, I think that you put your point on something. Why isn't this a meme stock, right? One of it is that the rise of passive investing. So the meme stock was very much retail driven. And every time another index fund is bought, there's probably less money available for people to punt, right? Individually. So as 5 years ago, you look at how much more is in passive indexes rather than just some yo bets.
Right.
It's a lot. And so these stocks have institutions on both long and short. And we actually measure this and can show you that, in fact, the hedge fund cohort makes up a huge amount of the active longs, and obviously they're all on the short side. So that's the difference. And also this is I think it's Battleground is interesting because the time frame is much longer. The institutional money, if they like it, it's a core position, they might be in Coles for 3 years.
Yeah.
This is not a 2-day, 5-day, 7-day spike, and then you get out and you dump it. The people are in there because they actually believe the story and they believe management. So the arc of these things is every single day. So watching the active money go back and forth, that tells you something.
What is your data talking say about Tesla? I mean, that's
Well, we actually made a call on Tesla before the show. We were bearish on it. It was actually off. We've seen a rise in short interest in Tesla, no question about it.
you're off today, but I mean, Tesla sounds like a basket.
Yesterday it was off like 4% before earnings, and we actually had that right, which was good.
It was down today. It's been down the last 5 days.
Yeah, we said it would. We had a bearish call on Tesla. That's what the data was telling us.
Is the data is saying anything sort of meta about Tesla right now? Because that's kind of like where people are looking at it. I mean, Elon came out and said, "Oh, you can expect a couple of quarters of bad stuff." When that happens, the usual suspects on social media who hate hate Tesla, chime in. This is the beginning of the end. Is the data suggesting anything sort of more profound than a trading pattern here?
Hard to say, because the arguments against Tesla are so well known, and also what I would actually say is probably if the sources of the, let's say, doom and gloom for Tesla were to actually change, that would be more meaningful than the increase in short interest. So, you get the same kind of folks pointing out to a lot of different, as they perceive them, flaws in the company. If that actually got wider, if the audience for that argument got wider, then I would say it's probably more fundamental. But this to me seems what you would expect out of a CEO coming on an earnings call and saying there's some rough seas ahead. You would naturally see longs bailing out of the stock and short sellers increasing their position.
And Dan Ives, the veteran tech analyst, longtime bull, is still a bull. He's calling for buying on the dip. So be that as it may. Winners and losers. Any good ones here?
So last week, not a great week for us. Our defense picks for Raytheon and Lockheed Martin were not good. But overall, I think we had 3 winners and we had 4 losers, so a little less than 50%. But overall, over the year, we're still around 60%. For next week, on Monday, Welltower announces, and we're bearish on that. That's a REIT. On Tuesday, you have Cisco, which we're SYY. We're bearish on that. UPS, we're also bearish. That's on Tuesday. We're also bullish on Carrier, and we're bullish on Starbucks. So the data says to us that we've got 3 bearish calls on Welltower, Cisco, United Parcel, and we've got 2 bullish calls on Carrier and Starbucks.
Any themes out of those that we can follow? Is it just?
Yeah, we look for there's definitely patterns and there's definitely mean reversions that happen with short interest and price action. So we look for those things that correlate to the price action, and that's what the model looks for. That's why some days or weeks we'll have 5 or 6 picks, and sometimes you'll have none. It's just that's what the model does, and that's what we're seeing.
I want to go back to Battleground stocks. One that caught my eye on your research, C3 AI.
Yeah.
As an AI company become a battleground? You would think this is the most bullish play around, right? AI.
Lot of short interest in that stock. And so what constitutes a battleground stock is when you see short interest about equal to long interest.
Are we seeing any of that in NVIDIA or anything like that? Or is this like,
well, NVIDIA is so big that you're never going to have short interest be for, it can't be what the active long is, which is probably about $400 or $500 billion, maybe more now. And the short interest at one time was $40 billion, right? So that's its own thing. NVIDIA became, the utility tool for risk management. You could short and short the whole market and actually get paid to do it, right? So in other words, it wasn't a cost to hedge. You could short NVIDIA and actually get paid to do it. So it's kind of the gift that keeps on giving. You could short NVIDIA and short basically entire S&P 500. A lot cheaper to do one stock than even the futures or things like that. So or the SPY ETF. So very, very different rationale there. But you're always going to have. It's such a big part of any index. You're always going to have. It's always going to be like 10 to 1 or 15 to 1 long to short. But you bring up a good point, Charlie, which is that yes, there are battleground stocks, but there are things that skew a little long. Things like a stock like Robinhood, which at one point was a real battleground stock. And what you've seen over time is that long investors, particularly active long investors, have gotten very, 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 very comfortable owning that stock, and they've increased their position over time. And you see that the amount of active longs for sure is like 6 or 7 times more. There was
management. We should point out management got its act together.
Yeah, exactly. And so
they have a very good general counsel who we know, Dan Gallagher.
No, absolutely. But be that as it may, it doesn't matter. The numbers are the numbers, right?
Yeah.
And so when you see something that was even, and then over time, long gets longer and longer and longer and longer and longer and bigger.
Yeah, that's fascinating.
Short interest stays about the same.
I just wonder if AI will be a battleground at some point.
almost definitionally has to be, because there's going to be big winners and big losers. There's going to be multi-trillion-dollar companies that get that come out of this technology, and then Netscape isn't around, right? So
Yeah, well, that's what I'm thinking. I'm saying, are we overplaying this AI bet? I mean, is it? I mean, the writing is horrendous. It's kind of good for looking stuff up, but I use a Google. I mean, now I have heard from doctors, it's great in defining parts of the body that need to be examined more closely, and obviously in cancer need to be addressed more specifically. I'm just wondering,
I
is
think you bring
this?
up a good point, which is what's the ultimate utility, which is anything that has pattern recognition, it's going to make it better, right? And that includes coding and how you
Right.
train the language model to actually do what you want it to do. Whether or not it writes better than Charlie Gasparino, or can actually get the trust that Charlie Gasparino has from his sources, or
I'm such a lousy writer. It's hard to imitate me. Just so you know, just if you're out there looking to do that.
we won't do that right now. We won't pull it up and say, please do this show in the voice of Charlie Gasparino. We won't do that. But
Yeah,
I would say that the application is still
nascent.
it's just so nascent, right? It's total, and I don't want to say Wild Wild West, because that there's a gold rush aspect to it. There's real utility to this technology. We use it. We obviously use it to do the machine learning that we do to produce our models and produce our data every single day.
Oh yeah,
We're looking at it for uh, how to code better and faster. I think, Reid Hoffman was on the other day saying, look, 30 to 50% of our code can be done through AI. So, that's a lot of jobs, and that's a lot of margin for the company. I just think,
where do you think the jobs to get into, not quite the data, but Bob Sloan follows more than just data. Where do you think the jobs, the plus side of the jobs, are going to come from in AI? Any
so,
idea? Because
well,
I mean, societally, we're grappling with this.
it's a great question. I tend to think that actually in the short term, more jobs will be created because you need translation. You're going to force massive archetypal companies are going to have to force their users to go from their workflow that they're doing today, and it has to be something that is AI compliant or LLM compliant tomorrow, and or programmatically, meaning you have to understand some Python or some kind of coding to do that, or have AI do it for you. That arc is not job destroying in my mind. You need translators, you need trainers, you need Salesforce, customer service. There's all
Yep.
sorts of different things. You're not going to walk in one day and go, oh, I'm doing my work this way, and tomorrow I'm going to do it this way. There has to be a lot of service involved in education to get people from A to B. So I think in the short term, it's actually job positive. In the longer term, pretty interesting, right? Those jobs may not get fired, but they just may not get repeated again. There's now no net new hiring, or maybe you need fewer people to train because you've trained everybody. But you think about it, right? If AI has its way, and Google, all of a sudden you're not Googling and you got to use AI. The one thing that Google did so beautifully is look at, their search page is still incredibly simple.
Yeah, very simple, just and chock full of information that's much
Right.
more.
So it's
And by
hard
the
to
way,
do, right?
and you can, instead of something spitting it out at you, you can discern between the sourcing, right? AI, you can't discern between the sourcing.
That's right. And so, but, maybe over time, the precedence of what are sources and what are trusted sources, not trusted sources, but training the entire globe to do something differently that it's just more or less gotten comfortable with. It really has. I'd say in the last, 3 or 4 years, right? 5 years. It's basically everybody knows how to do it, right? The adoption rate's almost 100%. The adoption rate for AI is, what do you think? 10% today? 15,
Yep,
20?
yep, right now.
And I would say the persistency is really low. Whereas you still go to Google, a lot, like for everything, whether it's maps, your reservations, this, that, so on. Your
And if
life,
you're an
your
egomaniacal
Gmail,
guy like me, you're Googling your name constantly.
constantly, right? So that arc happens over a period of time, and eventually it gives people enough time to think through how they want to handle that. And it does bring up social compact questions. It does bring up work week questions and how long it should be and how much margin should a company actually get to keep, because it introduces this type of technology that could, even though I think in the short term it creates jobs, could eventually, you could see where it replaces a lot of different things. Do people show up for 2 days work? That it will have some time and breathing room to figure that out, even though these things are happening at breakneck speed.
I know. I mean, listen, I remember covering the early stages of the internet boom. Oh, we're going to put bookstores out of business and
Yeah.
that. Yeah, I mean, you did. There was some negatives.
Hmm.
There was huge positives. I mean, it created a gazillion businesses. Amazon itself is a small business sort of portal, right? You make a product, you want to build it, you sell it on Amazon. And so remember, that's it'll be interesting to see how this plays out. You got anything else for us this week, Bob?
No, I just one thing, we are getting a lot of really interesting kudos, Charlie, particularly your reporting. We're picking up a lot of different subscribers, and particularly in the financial world. If you're in the media business and you're actually writing financial news, please call us, because it's a disservice and it's disinformation to characterize things because it's easy.
Yeah, it's
Do
right.
the work. Do the work.
You help people define like
Yeah.
the trading
Yeah.
sort of ecosystem out there better than most people I know. I'm just a simple country reporter. I lean on you to like kind of make me less of a simpleton. And yeah, I mean S3 data is perfect for that. Speaking about being a reporter, I got a couple of headlines going on this week. By the way, I love that music, but I've never. Do you know what that song is from? Cool Jazz. Um, Top of the list, and we're going to get this guy on the air very soon, Bob. Curtis Sliwa is now, the business community is finally starting to look at him as a potential mayor of New York City. In a four-way race, they can't escape the fact that the guy with the beret, the Guardian Angels founder, actually has a shot. He keeps, he's right there within the margin of error to Cuomo and Mondami, the
Mm.
socialist Maoist Mondami. Zoran Mondami is, won the Democratic primary. He is over Andrew Cuomo, the former governor. He is the odds-on favorite. Cuomo is a close second in a four-way race, and a close third is Curtis Sliwa. He met recently with the head of the New York City partnership, Catherine Weil. That's the biggest business group in the city. He's going to meet with the members in early September when they're all here. They're out in the Hamptons, obviously, right now. And if he, let me tell you something, if he can sell himself to them, and it's a four-way race in September, no one dropping out, he's going to get a few bucks, and he could win. I'm not saying he will win; he could win. And if he does win, I know Curtis. There's a caricature of him with the beret and the jacket and kind of very out of borough brogue. He's a really smart guy. He apparently, when he went to speak with Wild, he kind of blew her he kind of blew her socks off. He kind of knew knows stuff about the city, and she was like very favorably impressed. I don't know how you could say he's less sort of with it than Eric Adams. I mean, sort of struck operationally, Andrew Cuomo is probably the best out of all of them. But Andrew's got his issues, as we know. He did not beat Mondami in the primary. Mondami is a leftist that I think is only, he's held very few. He was he was a failed rapper.
Yes.
Yeah,
We've seen a lot of evidence
rapper.
of it already.
Yeah, rapper. With an R, and not not a WR. And he was a rapper, and then he got into politics. But the field is very thin. Curtis is no dummy. Just saying, it could happen. And if it does happen, it'll be interesting. He's very good on crime, as you know. He understands the budget. He'll cut stuff. Probably reappoint Jessica Tisch as police commissioner. She's done a good job in the 1 year she's in there. Probably the best move that Adams has ever done. Eric Adams is a nice fellow, but let's face it, hasn't really lived up to the challenge. Corruption has been rampant during his administration, and Andrew has his issues. So keep an eye on Sleewood. Again, he might drop out. He says he won't drop out, but who knows if he doesn't see a road to victory. But right now, this is still kind of an interesting race, four-way race with, it's anybody's game right now. The other thing I'm looking at is bank deals. Every major bank, I'm told, is actually looking to buy something. And why is that? For finally, the Federal Reserve is loosening the shackles on what these institutions, the major banks, can do. Will Goldman Sachs merge with JP Morgan? No, I don't think you'll see two big banks do something like that for a lot of reasons, including I don't think management wants to give up their jobs, either
Sure.
JP Diamond or JP or David Solomon at Goldman. But both of those players could buy stuff. The names you hear: State Street, Bank of New York Mellon, Northern Trust.
Yep.
There was a rumor going around that Northern Trust and Goldman were going to hook up. I've been reporting that rumor for a year. By the way, it's not happening. But that doesn't mean Goldman isn't going to buy anything. It's from what I understand, is looking at something in private credit, buying something significant in private credit. BlackRock did a deal in private credit. I think they bought. I can't remember the name of the company, but it was like
HPS.
HPS.
HBS.
Yeah, HBS, and it was I believe, a $20 billion deal. Did I get that right?
It sounds right.
It was significant in size. These companies are big. They're as you know, non-bank lenders. There's a lot of interest in private credit right now because they're not as closely monitored, less regulatory scrutiny. Obviously, there's a downside to that if you buy private credit instruments, and retail is increasingly buying that. But Goldman wants to go there, from what I understand. Credit UBS. Again, they want a bigger U.S. footprint outside of Credit Suisse, which they were forced to buy. So they're in the hunt as well. And there's probably a lot of deals that I'm missing here. But just remember, bank deals could be stuff you read about going forward. My last sort of headline involves Colbert. And what's interesting about the Colbert case.
Hold on. Just one second. First of all, everybody got to give a little clap to Mr. Gasparino. It's not every day you get the front page story of the New York Post.
Yes, I had what's known as the Wood.
It's the Wood.
It's called the Wood, and it was on Saturday. I did a story about the cancellation of the show, and the reason why, because this is such a big story in so many ways. It's a media story because they canceled him, and he was the king of late night media. It's a business story because they're trying. His parent company, which is Paramount, is looking to merge with Skydance, an independent film studio. The Trump Federal Communications Commission is throttling the deal, holding it back because they want concessions out of them, so they're less liberal, biased in programming. As a matter of fact, Paramount, in order to grease the skids for the deal, just paid Trump what a lot of people are calling ransom money, $16 million and $20 million of pro-MAGA ads on some lawsuit that he filed against CBS over their controversial Kamala Harris interview, which people say was doctored. They say it wasn't. I unpack all this in my story, and on top of all that, Colbert is saying that his cancellation was political, and the more I look at it, the less it looks really political. Listen, I'm not saying that he would have gotten canceled no matter what, and here's why. If you're losing $50 million a year and the trajectory is going higher in losses. You just get bought by something like Skydance, where it's an independent studio.
Yeah, you're going anyway.
You're gone.
Yeah.
And so he was gone. By the way, the deal should officially get its okay. Our sources are saying by mid-August, so we can finally stop writing about this story.
Charlie, question for you. So you bring up a great point. So were the losses accelerating, meaning advertisers were not buying time because of the maybe because of the antagonism in the deal, maybe the antagonism,
Combination.
a lot of different things at play. But at the end of the day, I read that I think the Senate wants to have a hearing on it. I don't know if it's the House or the Senate. If you're losing 40 or 50 million bucks a year, why is this a surprise?
It should be.
Why is it worth taxpayer money?
Well, it's not even that; it's shareholder money.
Right.
I mean, think about
the
that.
hearing costs money, and you got to.
Oh yeah, but that's just. But that will only happen if the Democrats control the House or the Senate. Then they can do the hearing, and because remember, it's kind of like clouded by the whole Trump settlement and everything. You can draw these conclusions, but the bottom line is this, and I don't know. Do you know a business that loses $50 million a year and pays its principal 20?
There are some hedge funds, but they don't last very long on that.
Like Stephen Colbert was making like up to 20 million a year.
And that's what you know about, right? There's always other things in these deals that they don't want to publish and make whatever. So
I mean,
I know that to be a fact. I'm just saying, I read a book about Johnny Carson, and they said he made $1 million a year. And then it turned out in the late 80s, he was making like $40 million a year. They had figured out how to keep the headline number, low and in.
Yeah, but he actually brought in 70 or 80
more. Wait, a lot more.
I mean, it was huge. I mean, everybody watched TV. I mean, we have cord cutting now. I mean, there's a lot of sort of more secular changes to the broadcast industry than just So there's problems here aside from him turning off half the country. But if you have problems and then you turn off half the country with very anti-Trump sort of comedy, and I put that in quotes, man, that's a recipe for losing a lot of money. I don't get it.
Let me ask you another question in this vein. I see that Barry Weiss's firm is maybe being sold.
It's a free press. The free press.
About 200 million. I saw Substack just did a round at $1.2 billion. What you are quintessential financial news reporter. You so are respected. What does it say to you when you have this whole drama with CBS and the value of the company is $8 billion, and you have Substack, and you have sports, Paramount, like real things, and you've got these other things at $1.2 billion too. So our guest last week, Ben Salisbury, was talking about how things come together and how they get destroyed over time. The Schumpeter creative destruction. I thought he did it really well.
Yeah, he did an excellent job.
What do you think it says? What do you think it means?
Well, I don't want to be too sort of off, I don't want to, I don't think we know enough just yet. I don't know what the Free Press's balance sheet looks like.
Right.
I have no idea if Substack is making money.
Right.
I mean, are these people just is there just interest in the concept of it as the old media fails?
Right.
By the way, old media still makes money. The last I looked, Paramount is still, it's got a profit of something.
Yeah, that's my point.
I mean, does Free Press have a massive profit that deserves a like $20 million? Would you say $200 million valuation?
No, yeah, they want to buy it for $200 million.
Yeah,
that's the headline. Who knows?
But who knows if that's true? So, but that's what I mean. I mean, are we? Every nascent business has an irrational exuberance part to it because you're planning for the future, so you don't really know. Now, something is going to be worth that irrationality. It won't be irrational. Amazon was worth the initial irrationality, right? Even though it went down. By the way, if you follow a stock chart of Amazon, you'll see it crashed after during the internet bubble bursting. But it wasn't Pets.com. That went up and crashed and never came back. So I think we'll do some of that here. But it is saying something that the market, smart people, are betting on that delivery system, the Substacks, the free press, the stuff that's over the top, that's that's combining podcasts and sophisticated commentary and news. It's saying that stuff is the future, not the sort of bread and butter stuff you get on regular TV and increasingly even cable. So that's kind of where the money is being bet. And how that shakes out, who's going to survive, I mean, we don't know yet. That we're not in that period just yet.
Well, that's one of the things I think next week we'll talk about with, we got some great guests coming up next week. We're going to do 2 shows next week because we got lucky enough to, the show is getting a following and people are interested in coming on. They know we're fair and we let people talk. And if they have ideas, we don't interrupt them and we try to give them the place to actually express themselves rather than trying to get our own points across. We're trying to actually elucidate from our guests what they're really thinking. So we have the great Jillian Tett on Wednesday. She's on the editorial board of the Financial Times.
Oh yeah, I'm sure she has a lot of opinions about what's going on in media right now.
The media, we can certainly been talking about that. And then on Thursday, we've got Ken Tropin from Graham Capital, is one of the most influential traders and investors, certainly in commodities, emerging markets, and it'd be fascinating conversation. So we've got a lot to do for next week. And, this week, I think it's a wrap. Charlie, what do you think?
Bob, the daddy of data, enjoy the Hamptons or wherever you are.
I'm here in New York City with you. So
all right, good for you. Again, this is Charlie Gasparino with the daddy of data, Bob Sloan from S3 Partners, signing off. See you next week. This is another great edition of Risk and Return.